Pensions and tax. They are joined at the hip. And there are a number of tax advantages and traps when it comes to saving for your retirement. So this is the first of two videos that I'm going to explain the top 10 tax tips that you should need to know about when you're planning your retirement. I have more detailed videos about some of these tips, so I'm going to give you some links as we go through the video. But first of all, my first tip is to make the most of pension tax reliefs. So tax reliefs boost the value of your pension pot immediately. You get 20% tax relief automatically on the amount going into your pension. And then higher rate taxpayers can claim back an additional 20% and additional rate taxpayers can get an additional 25%. That can be done either through your annual self-assessment tax return or through your workplace pension, depending on how it's administered. You may need to ask your workplace pension provider to make sure you get the extra tax relief. This means a high rate taxpayer is getting £100 in their pension for a net cost of £60. So that's a 66.7% return before any investment growth. Just be aware that basic rate tax relief is being reduced to 19% from April 2024, so you will need to contribute a little bit more to get £100 in your pot. Tax tip number 2, drop a tax ban via salary sacrifice. At some companies, the tax benefits could be even greater as they may allow you to reduce your salary or bonus payments in lieu of increased pension contributions. This is known as salary sacrifice, and it means that you, as the employee, agree to a lower gross income and your employer pays the difference into your pension alongside your usual contribution. The added bonus is that both you and your employer will pay lower national insurance contributions, which of course are set to rise in April 2022. If you are close to the £50,271 earnings threshold where the higher 40% income tax rate kicks in, you could dip under it by using salary sacrifice pension contributions, so that you don't end up paying excessive marginal rates of tax. Just be aware that some employee benefits such as life insurance, holiday, sickness and maternity pay could also be affected, as these may be based upon your gross salary. In the long term, your national insurance contributions record and state pension entitlement could also be affected, so be sure to check the exact rules. For more on salary sacrifice, check out my video, which I'll put a link into the description below. My third tip is to know your allowances. If you are able to lock away your money until the minimum pension access age, which is currently 55, but due to rise to 57 in 2028, you should seriously consider any available tax advantages. But there are ceilings on what can be saved tax-free. There is the annual personal allowance of £40,000 in the 2021-22 tax year for pension savings, as well as the tapered annual allowance affecting the higher earners, which can reduce the allowance to as little as £4,000. You also cannot contribute more than 100% of your earnings to a pension during each tax year. On top of this, well, you can, but you won't get the tax relief. On top of this, there is a lifetime allowance, which is currently set at £1,073,100 and frozen at that level until 2025-26. Fourth, use carry forward for unused allowances. Pension carry forward rules allow you to use unused allowances from up to the 3 prior tax years in the current tax year. You must have already maximised your current pension allowance, annual allowance, and still be in the same pension scheme. So this may be that you've got a promotion or you've had a windfall or something like that, and you've got some spare surplus savings that you can now apply into your pension that maybe you couldn't afford before. Tax relief would be applied at your current marginal rate, and so carry forward can be very attractive if your earnings have risen significantly. Remember, you're still limited to 100% of your salary in the tax year to get the tax relief, that you are making the contribution regardless of how much you have available from previous year's allowances. The fifth fact is know that you can get access to your pensions tax-free from the age of 55. Up to 25% of your pot can be accessed tax-free, with the remaining 75% available as taxable income. This option is not suitable for everyone, but it might be right for you depending on your circumstances. Remember that the earliest age you can access your pension is rising from 55 to 57 in 2028. So look out for the second video outlining the next 5 things that you should know about pensions tax when planning your retirement, starting with the money purchase annual allowance. Subscribe to receive an alert of when I release that video. Thank you so much for checking out my YouTube channel. I really do appreciate it. I'm Justin King. I'm a chartered and certified financial planner, and my aim is to help you live a successful life. That often involves understanding your money. I hope you've enjoyed this video. If you have, please press the like button to help more people like you find my channel. And for now, I'm Justin King, helping you live your best life.